Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Bouncing back, Japanese stocks surge, leading Asian equities higher after Monday's market rout. European and US futures also pointing to gains. A major Treasury rally ignites debate on the pace of Fed rate cuts. San Francisco Fed President Mary Daly says the jobs market is slowing but not falling off a cliff. Plus, a US judge rules Google monopolized the search market through payments worth billions of dollars to Apple and others.
In the meantime, a quick check on these markets. Green on the screen when you look at the futures picture on both sides of the Atlantic. Your stocks 50 futures higher by a whopping 1%. Outperformance again of FTSE 100, perhaps following a little bit of the oil price. We're going to dive into the details there. But even in S&P futures and NASDAQ, you are seeing a recovery in the overnight trade. We should also mention we've got one eye on the currency space. Dollar yen, 145.90. The countdown to the opening trade starts right now.
'Tuesday the 6th, good morning. Welcome to the opening trade. Is that it? Is it over? Has the correction run its course? Is it safe to put your toe back in the water? Certainly, we're seeing a significant amount of dip buying out in Asia this morning. We'll get to that in just a moment. But the key question, I think, in a lot of people's minds this morning will be, have positions been sufficiently cleared out in order to generate the right kind of environment to get back into this market in a meaningful way? Or is there more selling still to come? Kriti, first thing this morning, it looks like Asia is trying to answer that question very much in the positive vein that we are seeing in terms of the pricing around the topics, around Asian equities more broadly, a big bounce coming through. Yeah. But if you look at it over a 3-4 day basis, it doesn't look that big.
Well, a 10% jump in a single session is big. But just because it's green on the screen does not necessarily mean it's a positive development. I think that's the takeaway here, that we're still going to see a couple of days of pretty violent swings. You saw it in the carnage of 2022 globally. You saw it during the COVID sell-off as well. So we're going to see continuation of that. It almost feels like, though, the volatility you're seeing in the stock market, you're not necessarily seeing in the FX market, especially if we're talking about dollar yen kind of being part of this unwind trade globally. You're still looking at dollar yen at a 145 handle ahead, by the way, or I think a meeting actually just kicked off, a meeting between the Ministry of Finance, the DOJ, and I believe some of the other regulatory
authorities. It has moved quite a bit, though, hasn't it, from the levels of real yen weakness that triggered the first interventions from officials in Japan. But maybe we are not seeing as much volatility there as elsewhere. But yes, we are waiting for this meeting to take place then. Interesting, we've got Mark Cranfield on the Markets Live blog taking lessons from 1998. You've mentioned all kinds of other lessons. And there the lesson was that we saw big movements in dollar yen and then it kind of meandered. And I wonder to what degree where we go on dollar yen is crucial. It's one part of a really complicated story as to why stocks dropped.
I think that if I look across the piece and I look at all the various asset classes that we've got out there, the story that I think that unites them all is volatility. And volatility is up quite sharply. You can see it in the VIX, you can see it elsewhere. It's part of the carry trade that Kriti's been talking about. As that unwinds, it is basically as a result of the period of low volatility coming to an end, and as a result of which you've got to reposition very quickly. There's the VIX. Look, we got to 60 on the VIX yesterday. That is an epic move. But I think actually the period before it is more significant than the spike. And the reason for this is that we've allowed positioning to get very extended. We get a spike in volatility. How quickly does that positioning unwind? Beata Manthe out with a note this morning. While our bear market checklist recommends buying into weakness, we would feel more comfortable doing so once we see evidence of a more complete positioning unwind. Have we seen that positioning unwind yet?
Well, there's the positioning unwind, and then there's some of the fundamentals as well. It's interesting that even though we're talking about potentially green on screen and a revamp in some of these markets, now you're getting some of the fundamental news, Anna, when it comes to some of these big tech names that have been driving the downside. I'm obsessed with all things regulatory scrutiny. The DOJ now pushing back on Google. It hit Apple shares yesterday, of course, as part of the fundamentals. Even NVIDIA getting a delay on the AI chip.
Yeah, absolutely. So you're rightly flagging some of those fundamentals that sit alongside that more sentiment story. Interesting thinking about these parallels with history. Ed Yardeni going back to 1987 and saying there we were really all afraid of a recession because that's the one of the drivers of this sell-off that we haven't talked about, US data. And he was saying actually at that period we were afraid of a recession and we didn't end up getting one. So we'll see if we have any parallels there. And thinking about where that goes, how central banks respond, whether central banks see a recession coming. Yes, they're all about the data. We heard from the Fed's Daly overnight saying the labour market is slowing. She's saying it's slowing, but it's not falling off a cliff. And I think it's really interesting in the context of the RBA. What you're seeing there is a fairly hawkish told from the RBA. They were talking about a rate hike. They're not talking about rate cuts. They did consider a rate rise. A near-time rate cut is not on the agenda. And it's just a reminder that even though it can feel in the markets very volatile and there is a lot of volatility, there's no sense that central banks suddenly go, oh, unemployment in the US is at 4.3%, we must cut rates.
But the fear here will be that a lot of people will look at this, Kriti, and go, the Fed's making a mistake.
Yeah.
And the longer we hear commentary like this from Daly, that's only going to further exacerbate that, and that will only heighten the sense of concern around the possibility of a hard landing rather than this soft landing we've all been promised.
Well, the gray area here is what is a slowdown, one that does warrant the R word, the recession, and what is simply normalization, because there's still that COVID overhang in terms of the labor market being extra strong, a resilient American economy, and arguably even continued resilience in Europe that we didn't think would last this long, plus not to mention plenty of stimulus money that's still kind of are running around.
Maybe some of the positioning around tech stocks was pretty abnormal, but for the rest of these drivers, and what the BOJ has been doing is pretty abnormal, but for things like the state of the unemployment story in the United States, maybe we just need to get back to a period where we're more used to central banks acting slowly, gradually, in a more usual fashion. We're just so conditioned by the GFC and by COVID and all of these crises to expect that's the way that central banks operate.
We will see. It depends how far this move goes, I guess. It could create the weather. It could change the narrative for the central banks. Let's talk about the guests we've got coming up. We've got great guests lined up to talk about all of this. Guillaume Menuet, Head of Investment Strategy at Citibank Private Banking. That conversation coming up at 7:15 a.m. Shortly after, Max Kettner, Chief Multi-Asset Strategist at HSBC, will be joining us around the table as well. His take on the Tuesday turnaround. Finally, 8:15 a.m. UK IHG Hotels and Resorts CEO Elie Maalouf will be joining us. We've just had the latest numbers. What are we learning about the state of consumer spending? How is the consumer feeling? The hotel story, I think, is part and parcel of that narrative, Kriti.
Yeah, so we're going to have those really important conversations. We're also going to have the data throughout the rest of the next 24 hours to come alongside it. I'm going to walk you through what the agenda looks like. 10 a.m. UK time, we get those Euro area retail sales. So, again, talking about that theme of whether or not we see a resilient European economy. And then at 12 p.m. UK time, this is interesting. I usually don't flag something like this, but you have Brazil's central bank meeting minutes. And the reason I think this one is so important is because this is a very big part of the carry trade right now. Brazil is in focus. Mexico is in focus against the likes of the Swiss franc and the Japanese yen. So any kind of moves from those central banks are also going to have an impact on that FX trade and then the broader ripple as well. But you were talking about that consumer story for IHG. We're going to get plenty of that in the States as well. Airbnb, Uber, and then Caterpillar reporting as well. Yeah,
Caterpillar, often seen as quite a bellwether, isn't it, and in terms of where the US economy goes. But there could be some complicating factors I'm reading in our preview this morning. Some optimism coming from what the energy and transportation part of this business is doing and how much that tells us about the global or the US consumer or the US growth story, I'm not sure. But it's always interesting to watch.
There was a note out from Torsten Schlock talking about the fact that actually US industrials are turning a corner as a result of the CHIPS Act, as a result of the Inflation Reduction Act. You're seeing industrial production beginning to pick up. I'm assuming that at some point you've got to build a factory. Usually when you build a factory, you probably end up with a piece of Caterpillar kit somewhere involved in that process.
Well, there's also a China read-through here, of course, that Caterpillar is going to get a major, I can't remember how much of their segment. I'm looking it up on our candy-dandy Bloomberg chart. About 20% comes out of the Asia-Pac region. A good chunk of that, of course, is China as well. So this is significant in terms of that. But I think for the manufacturing story that you're talking about, labor is a big piece of that equation as well, especially in autos, industrials globally. Wage hikes are a big part of the conversation.
So we'll look for clues in those Caterpillar numbers. Here's what else you need to be aware of this morning, keeping our focus on the Middle East. US Secretary of State Anthony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. He says the US and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Prime Minister Keir Starmer has hit back at Elon Musk after the billionaire said, quote, civil war is inevitable in the UK. The Prime Minister said there's, quote, no justification for the billionaire's remark. The row comes amid concerns online disinformation has fueled the unrest of the past few days. And Kamala Harris has clinched the Democratic nomination in a virtual roll call vote. Meanwhile, Reuters says that Harris has narrowed the search for a running mate to Pennsylvania Governor Josh Shapiro and Minnesota Governor Ted Valz. I mean, what do we need to take away from this conversation then, Kriti, about the search for VPs and the stage of appointing Harris that we have got to in this process?
Yeah, this is a little bit of inside baseball here, or inside cricket, if that's the term that goes on this side of the Atlantic.
I've never heard that, but yes.
It will be now.
I'm making it a thing. But I think this is important because it speaks to kind of her campaign strategy. Is she looking for the swing state vote, which is what Josh Shapiro of Pennsylvania really offers, kind of some edge over President Trump where he's leading. Tim Walz is a big kind of labor person out in Minnesota next to Michigan, which is, of course, still a democratically majority state in terms of the state legislature as well. You also still have a couple of names out there. Andy Beshear of Kentucky, a big UAW endorsement from the unions. So I think it's going to be crucial to see what Kamala Harris is actually shooting for in her campaign strategy. But I think, to be honest, in the last 24 hours, the biggest story is that we've got our first female, Black, and South Asian nominee, and that is a very important moment in American politics.
Hugely important moment. Does the other story of the last 24 hours, which is we are seeing recession fears beginning to grow in the United States, feed into this story as well. She's had a really significant bounce. Could you see that starting to come unstuck a little bit if we see concerns about the US economy growing? And does that feed back into the Trump narrative?
Somebody who is in the States right now experiencing the US economy, the UK Chancellor, Rachel Reeves, coming up on the programme. We will bring you part of our conversation with her. She says she won't rule out increasing capital gains tax as she warns of difficult decisions ahead. More from that exclusive interview later in our show. Plus, sources tell Bloomberg the rollout of NVIDIA's next generation AI chips has slowed due to engineering problems. We will bring you the details of that later in the programme. Up next, we'll discuss Monday's market meltdown with Citi Wealth's head of investment strategy and economics for EMEA. If you have any questions for our guests, please do get in touch. We'd like to hear from you. IB plus BBTV Go is the function to use this Tuesday morning on your Bloomberg terminal. This is Bloomberg.
You know, from my mind, we've now confirmed that the labor market is slowing, and it's extremely important that we not let it slow so much that it tips itself into a downturn.
But don't focus too much on one piece of data. San Francisco Fed President Mary Daly speaking yesterday about the potential impact of weakness in the US labor market. We're getting there. We're not too concerned at this point. We are seeing a slowing. If that slowing is manageable, then we will manage it as we work our way through potentially a rate-cutting cycle. It could come at some point, but we don't quite know yet. The market got very excited yesterday, though, didn't it, about the possibility of Fed rate cuts, emergency Fed rate cuts. Was that ever really on the table? This is what markets look like this morning. As you can see, European futures broadly positive. This isn't a huge bounce back. It's certainly not the kind of extremes that we are seeing out in Asia, where we have seen Japanese markets in particular bounce back very strongly. What do we do with all this? Guillaume Munuet, EMEA Head of Investment Strategy and Economics at Citi Wealth, joining us around the table. Good morning.
Morning.
How close do you think we really got to emergency Fed action yesterday?
We are very far, and we never got even close.
Okay.
I think that.
So what was yesterday?
Yesterday was a clear position unwind.
Yep.
In terms of the.
Have we cleared those positions?
I don't think it's over yet, because there will be consequences in terms of asset allocation coming through. My job is asset allocation, and we're going to have discussions during the course of this week as to whether we want to adjust portfolios in a way that's consistent with market moves to position for.
And your gut feel is what? That you probably do want to adjust, or are you confident with where you are now?
My gut feel is that this is an opportunity given to us by markets to perhaps reload and look at non-US equities.
Okay.
Look at non-US, did you say?
Yes.
Yes. So is that because US was overvalued, therefore this is a healthy sort of pullback in some areas of the US stock market, and it's just a reminder to look elsewhere? What's the rationale?
I think the rationale is that you have markets which have seen valuations increase tremendously, with a very narrow focus on mega-cap tech names in particular, while the rest of the globe is performing decently in terms of the direction of economic activity, and we have to position portfolios for the next 12 to 18 months. So do we believe in the recession call in the US? Not really. If that's not the case, then there are much cheaper equities out there that make sense in terms of asset allocation and portfolio construction.
So you don't believe in the recession. So what's the most compelling argument for not seeing a recession ahead in the United States? Is it that the jobs data just isn't as weak as all that? What's the story?
I think the story is one where we've seen already quite muted output data, muted retail sales data, and we're not coming up from a very high level. And therefore, there is not very much likelihood of a recession outcome coming through, which would have been anticipated by economic agents, whether they are firms or households. And the Fed has got a lot of room to cut interest rates. They can certainly deliver larger amounts of cuts over the next 6 months than the market currently prices it, if they think this is the right thing to do. So I think the recession story is possible, but quite unlikely. But the market was no landing. Now we're looking at soft landing. Some just veered a little bit towards hard landing. I think we're probably still within the sort of soft landing category.
Well, these market gyrations when it comes to Fed pricing will go back and forth for forever, I think. But let's bring it back to the actual position unwind that you started the conversation off with. How much of the stock story is related to the FX and bond story? Are they interrelated? Is there an unwind? What are you hearing from the people you're speaking to?
It is interrelated.
Margin calls, how are you thinking about it?
Everything is happening at the same time. But I think the carry trade unwind is really what I think is scaring a lot of investors because of the leverage in the system plus the positions that we've seen being built over the last 12, 13 months. So the Bank of Japan starting to normalize interest rate policy perhaps a little bit faster than expected, I think has been to a certain degree the trigger. Overlaid on that, this sudden hiccup in the US labor market.
How big of a problem is that carry trade? Because we know that so much of that is a function of the yield. I read somewhere that it was like a $4 trillion unwind. How much of a ripple effect does that cause? Is it one that reverses in a week's time when some of the bond and stock volatility also reverses?
I don't know whether you can reverse a carry trade unwind in the sense that it's now set in motion.
Yeah. And
it's going to depend now on the speed of adjustment of central banks, the Fed cutting and the Bank of Japan hiking. But I'm not sure that the Bank of Japan now will hike very fast in this environment. So maybe we have a pause and we have the rest of the week to see how everything falls out in terms of consequences and correlation between asset classes. I think we probably headed for slightly weaker valuations into end of this week. Equities.
Did equity markets, did markets more broadly, did equity markets in particular, though, get out of kilter? Have we got out of kilter with the real economy? And the kind of the line that joins them should be earnings.
Yes.
And I'm wondering whether the earnings are sufficient to justify the valuations. It was interesting, Mike Wilson's out with a note. He says we're kind of at 20.5 in terms of S&P multiples. We probably should be somewhere around 19. Do earnings justify where we are? And is what we are seeing now going to help us bring us back to more reasonable numbers, which are more sustainable numbers?
We were never in the camp of very aggressive earnings forecasts for 2024, 2025. I think combined is about 13 or 14%. So we're talking an 8% year this year, a 6% year next year for the S&P 500. So you can argue that perhaps the market was looking a little bit expensive in certain metrics and certain sectors, and particularly the tech names. But if you look at ECP equal weight, that is quite cheap. And the equal weight is the economy. Do we think the US economy will be stabilizing next year and rebounding into the second half of 2025? Absolutely. Do we believe the global economy is going to be on an upward trajectory?
You buy the equal weight at this point, you don't buy the S&P. Has that tech story, how much further has that tech story got to unwind?
Perhaps a little bit, and it depends on the earnings story for the next 2 quarters. I think the amount of investments and capex which has been made towards generative AI, I think is still going to support the industry structurally for quite a while. But I think the valuations looked quite expensive in terms of multiples. So the pullback is now creating the conditions for investors either who missed out on the trade to go in, let's say in a week or so, or the others to say, was my portfolio too narrow, too concentrated in US tech names? Do I believe in the global recovery story, which I think is quite logical given how lower interest rates will be, and then you brought them down.
So that's the stocks view. Thinking about the various drivers, and that relates to perhaps overvaluation of some US stocks. We've talked about the state of the US economy. Kriti also taking us back to Japan and the carry trade there. How did the carry trade unwind? How did it take people by surprise when it'd been talked about for so long that the Bank of Japan was going to move in the way that it did? And was it just that the speed caught people off guard?
I think it's the latter.
Yeah.
It's the latter, and the fact that suddenly one of the pillars of the story of the US labour market resilience started to crumble a little bit at the base.
Because I had some people yesterday saying, this is extremely poorly timed from the DOJ. But if they were looking for the max impact, in that sense, it was extremely well timed. They got a really big move in dollar yen, but bigger maybe than they would have intended.
That was one of the few tactical trades, one of the few tactical trades we got wrong this year, and we doubled down because we thought the yen had to appreciate. So we're not particularly surprised at dollar yen downside at the appreciation.
Don't you always get caught out by carry trades this way though? Isn't the carry trade is like picking up dimes in front of a steamroller? At some point, the steamroller turns up.
Well, it's meant to be volatile by design, right? It's high risk, it's high yield, and that's the beauty of it, or the danger of it as well. But how much does capital flows affect this, specifically when it comes to the yen? How much of this is that carry trade unwind and that interest rate differential not paying off, as opposed to Japanese citizens repatriating? How much of it is that?
I think it's very difficult to disentangle. But I think that the end of it has to be based on interest rate differentials between what the Fed is going to be doing and what the Bank of Japan is doing. We think it's about 200 basis points until really the carry trade's value completely disappears. So you still got some room, right? It's not the game is not over yet. But I suspect that the speed of adjustment also has to do with fairly low liquidity markets, summertime, where people were very interested in watching the Olympics.
I hear that. I relate to it. I'm a big fan. Let's talk about the bond market as well. We're talking about the momentum of the move as well. A 45 basis point move in 3 days in the 10-year yield feels concerning for that very reason. How much of that is that dry powder being put forward? Square to us, if you can, kind of the amount of money, the record amount of money that was in the front end of the curve into money markets that is being deployed in other parts of the market. Is it? Or is it just diving into 2 years? How is the bond market working in the States?
I don't think that there's going to be a lot of appetite for a lot of duration extension in the longer dated maturities of the US curve, simply because of the political risk and the fact that you have concerns about debt sustainability. But that's not just a US question. It applies to most of the G10 space. So I think what we're saying to investors is think about belly of the curve. That's where you get the most juice. That's where, in a still high interest rate environment, you can lock in income, and you can do so at historically attractive yields, despite the fact that we've seen a little bit of a pullback.
All right, we'll have to leave the conversation there. Guillaume Menuet, Mia, Head of Investment Strategy and Economics over at Citi Wealth. We thank you so much. Guy, Anna, he mentioned the deficit at the end of it, the bond market story. I'm obsessed with this because before the new U.S. president is elected on, I think it's January 20th, the U.S. government hits a debt ceiling, and it's a lame duck government. There isn't much that can be done about it. And it doesn't feel like anyone's pricing for this very scary inevitability when we just saw a mini panic over in France.
Yeah, I mean, I feel like we've been here before, though, haven't we? And every time we go there, we say we've been here before, and it always gets sorted out somehow, which sort of dulls our sensitivity, I suppose. You're right to point out to these risk factors on the horizon.
Are we going to have high yields? I think is a sort of for longer. I think is the question that I think a lot of people in the markets are still coming to terms with. This period is going to have an effect. And it was interesting, one other note that I read this morning was talking about the fact that the market's now coming around to the idea that actually higher yields and strong growth are antagonistic. At some point, one of those two things is going to have to break. Yeah. But I think the other thing that to take away from the last 48 hours is that bond yields did act as ballast. That you did, it did protect your portfolio.
The flight to safety very much showing up yet again. Well, coming up, we're going to continue the market conversation. Our next guest arguing that sell-off periods tend to be short-lived, but leave few places to hide. Max Kettner out of HSBC joins us next. Stick with us. This is Bloomberg.
Tuesday the 6th, 30 minutes to go until the start of trading here in Europe. We will bring you that opening trade in around 30 minutes' time. As we count you down towards it, let's check in and see where futures are this morning. As you can see, a positive picture, but not that positive. But on the other hand, Europe wasn't the epicenter of the action yesterday. Certainly that story is true out in Asia, where we did see Japan moving a lot yesterday and moving a lot today. So equity markets in Europe, reasonably calm relative to other places. The bond market, I think, is really interesting right now. Big focus on the Fed. I haven't heard the ECB or the Bank of England being talked about a great deal over the last 24 hours.
No, and maybe they're grateful for that.
Probably, yes.
Thinking about where we are then, yes, we've got this sort of turnaround Tuesday happening, as you say, Guy, in stocks over in Asia. And what's happening in bond markets does reflect that a little bit. Yesterday, of course, the story was those yields dropping, a lot of appetite for treasuries. Today, we see treasury yields a little firmer, but certainly we're not unwinding the moves we've seen in the last few days. And here in Europe, we see bond yields just ticking up ever so slightly as they start to trade this morning. So lots of talk about where the Fed goes, lots of talk about where the weakness in the US economy takes us. We caught up with Edward Yardeni and got his thoughts on whether we are heading, indeed, for a recession. Let's listen.
This is very reminiscent so far of 1987, when we had a crash in the stock market that basically all occurred in one day. And the implication was that we were in or about to fall into a recession, and that didn't happen at all. It had really more to do with the internals of the market.
Ed Yardeni of Yardeni Research, of course, there, speaking about what happened with equities back in 1987. He takes us back to that parallel. Let's get the views of Max Kettner, Chief Multi-Asset Strategist at HSBC, who joins us this morning on set in London. Very nice to have you with us, Max. So let's take the bird's eye view of what's just happened over the last few days. Although, interestingly, our story puts this in the context of the last 3 weeks and tells a story of stocks dropping more than $6 trillion over that period. But you think now you've got a model that tells us we are in a sell-off period, but the good news is that sell-offs don't last very long. Are we done then?
I don't think we're quite done yet, but I do think there is going to be a buying opportunity pretty soon, because in terms of the fundamentals, nothing's really changed dramatically, right? So we're not really seeing things falling off a cliff. In fact, when we look at most of our global sort of leading indicators, US leading indicators, most of them are still either sort of flatlining or still going up. But yes, there is still, I think, on average, according to our model, it sort of lasts around 1 month, right? The drawdown is around 10% in the S&P, so we could go a bit further. But of course, we've got the VIX already close to 40, right? So perhaps we're nearer the end, and we are already seeing some of our shorter-term sentiment and positioning signals, particularly things like, technicals, things like the VIX futures curve flashing really, really big buyer signals.
Okay.
So it's just that it's just a few of them, and some others are just really catching up with that and going from very absurdly bullish levels to sort of neutral levels. So we really want a bit more of a washout, a bit more of a further one, and that's probably the time where you start getting.
Okay, a bit more of a washout required before we get back to confidence. You don't sound overly nervous, though, Max, and maybe some of that has to do with your fundamental view on the US economy and where the weakness is. We heard from Mary Daly overnight saying, yes, where there are, the labour market is cooling a bit, but it's not falling off a cliff, was one of the things she said, although we shouldn't let it get too weak, was another. What is your view? Do you think some people are overplaying concerns about weakness in the US economy?
Oh, absolutely. I think, collectively, we probably should all be taking a bit of a chill pill. Because at the moment, when we look at, for example, on Friday, the labour force grew by 440,000 in July, right? And we've seen job growth of 115,000. So it's not like we're seeing big job cuts. I get it that, companies like Intel and job cuts there, it grabs the headlines. Absolutely. But when you look on aggregate, look at job cuts, look at layoffs. In fact, when we look at layoffs, they're still lower at the moment compared to the lows in the 2010s.
That's the point that Daly was making as well. But is that always a lagging indicator? And so by the time we get there, if that's the data the Fed is waiting for, then the Fed will be late.
It's either, at least historically, it's either concurrent or it leads by at least 1, 2, 3 months. Right? So it's not something where we would say, well, we'll find out in 6 months that the job cuts have happened, but then the recession we're already in it, or maybe we're already starting to get out of it. So I don't think so. I think, in fact, when we look at the labour market, what's really, really different, and with the obsession around that SARM rule that we've got, look, what is different right now is when we look at the SARM rule, for example, we've never had in the last 65 years in that backtest, we've never had a period where for 3 years it's been gradually increasing. We either had it sort of oscillating around zero or it explodes. Right? But we've never had this gradual loosening. And a lot of that comes down to immigration. A lot of that comes down to population growth that's been 0.5%. normally in the last 10, 15 years on trend. And in the last 2 years, we've seen 1.5%. We've seen the labor force grew dramatically more. And therefore, that's sort of pushing automatically the unemployment rate up. But it's not really the layoffs and the job cuts.
VIX is at 38 right now. Does it go back down to that period of very low levels that we've seen for a very long time that allow positions to build and build and build? Or are we in a higher volatility environment?
No, I don't think we're in a structurally higher volatility environment. I don't think so. Because, I mean, at the end of the day, what we've had now is what we've sort of described as a triple whammy. You had these, and I think what Anna was saying is very important. It didn't just start on Friday. It started 3-4 weeks ago, which is why we could potentially be already closer to the end of this sell-off. Because, you know, we had this triple whammy of AI concerns, or tech concerns, rotation out of Magnificent Seven. And then we had, obviously, the unwinding of the global carry trades with the yen, and at the same time we have the recession concerns. I think if we had just the rotation out of AI stocks, we'd probably still be talking about, well, do you think we should be rotating into small caps? But now it's all come at one point, and that sort of is too much for
But the systematic funds have been able to buy and buy and buy and buy because the low vol environment has encouraged them to do so. Their models would have told them to do so. You've had positive gamma hedging as a result of the fact that people have been buying calls rather than puts. Put call kind of story is reversing pretty sharply right now. People are looking to hedge. How long does the effect of the kind of the once bitten twice shy, is the market going to be an environment where it's less willing to take on risk as a result of what we're seeing now? Is it going to be more cautious? It's getting harder and harder to be aggressively positive.
I think if the VIX was, let's say, still at 20, I would agree with you. When we are close to 40, in fact, what you can see is when you look at the VIX, the level of the VIX, starting level, and you look at sort of forward performance, 1, 3, 6 months of equities versus rates. Once you sort of scratch 27, 28, your forward returns, if you have a time horizon of 3 months plus, start becoming really, really unambiguously positive, right? They really start becoming really positive for equities over fixed income. So, you know, given that we're sort of scratching at 40 now, we're definitely in this area where if you can stomach some shorter-term vol, we're obviously looking more for the definitive buying opportunity. But that then, you know, with a bit of a longer-term horizon, is actually pretty good. And I would say one of the things that you mentioned, put-call ratio, for example, is actually one of the things that we are still lacking in our analysis. When you look at the put-call ratio, it's gone up, but it's still nowhere near as, for example, inverted as the VIX futures curve is. When you look at put-call ratios and rates, yes, they've gone down. So, yes, there is demand for safe havens, right, even in the option space, but it's not yet as pronounced as you would expect it in that kind of equity sell-off.
Well, speaking of safe havens, Max, hold that thought, because we are getting headlines coming out of what it looks like is the Ministry of Finance. This is, of course, the Vice Minister of Finance, or Vice President, excuse me, of the Ministry of Finance, making some comments here after that meeting that we had seen between the DOJ, the Ministry of Finance, and I believe the FSA. So, well, basically saying that there is no change in the view that Japan's economy is recovering, that they are going to be communicating closely with the DOJ, and they will keep watching the FX development closely. I think, Anna, you pointed this out. The most interesting headline coming out here is that they are in communication with overseas authorities as well. And this is, of course, commentary coming out from the chief currency diplomat over at the Ministry of Finance. This is basically the guy who's been in the job for about a month and is getting a very quick kind of deep dive into the role, but is basically making those calls at the top.
Yeah, things come at you fast, don't they, Max?
Well, speaking of, and which I think brings me back to this carry trade story as well. We were just talking to the previous guest about how the stock market unwind is potentially related to the FX unwind as well, and that the carry trade may have actually been the bigger worry in all of this. Your thoughts on how long this unwind lasts?
I think a lot of it depends on the yen. A lot of it depends on the interest rate differentials as well. What we have seen, of course, is that the yen, if you look at dollar yen and you look at US versus Japan rate differentials, both nominal, real rates as well, long end and the front end, I think the last sort of 3-4 months, we've really diverged from where interest rate differentials were heading. So it's not only important what happens in Japan, it's also important if, you know, actually markets start to price at perhaps these probabilities for an emergency rate cut by the Fed. They start maybe pricing out some rate cuts by January next year. Not saying entirely, but maybe, you know, we're only going to get 3 or 4 rate cut instead of, so maybe we're only going to get 75 and 100, right? So we've got to price at like 30, 40 basis points of cuts. Suddenly that differential goes up again. I wouldn't, I'm not on board for people to say, oh, you know what, dollar yen has to go to like 130 now, like 130 is the next target. In fact, when we look at it against rate differentials, it's much closer now.
Yeah.
That sort of unusual divergence that we've seen in the last couple of months, that is closing now, or in some parts has already closed. So that's pretty good.
Would you still look at Japanese assets as a potential place as a hedge in your portfolio, whether it's the currency picture, whether it's Japanese banks, whatever that is? Does it still play that role in a portfolio?
Look, I think Japanese equities right now, when we look at some of our machine learning models, they've clearly undershot some of the fundamentals. So Japanese equities, away from the hedging, they're actually probably worth a bet now because, they've clearly undershot those kind of fundamentals that we look at. When we look at the Japanese yen, yes, I do think so, but it really depends on the, interest rate differentials. And there, probably in the inflation and the disinflation story has been too much of a global one rather than a local one. I think in terms of hedging and in terms of also diversification, what we've seen in the last 2 years is that sort of the only place really to hide where you get that is commodities, whether that's base metals, whether that's precious metals, right? Whether it's gold, whether it's energy. So you see in correlations very clearly that sort of everything is moving together. FX, credit, equities, right? Everything's moving together except for commodities. So it's actually commodities, perhaps, in terms of more geopolitical risk or some more of a pickup in terms of jet fuel demand.
Yeah.
That could be actually arguing for oil right now, where we perhaps might be burying the inflation theme a little bit too soon and too prematurely now, where actually oil might be a bit of a hedge now.
And yeah, people talking about geopolitics putting a floor under some of those commodities. You've been looking at the anatomy of this sell-off, Max, and what, under the hood has been driving it. Often we see at these times of market turmoil that people sell what they can, not necessarily what they want to. So what do you think has been oversold? When you're looking for those moments to come back in, where will that be, do you think? What's overdone?
Yeah, look, I guess it's exactly that kind of thing, right? In a sell-off, you sell first, you ask questions later. And what we're doing right now is we're trying to figure out the point where people are like, right, I'm at this point where I should be starting to ask questions again. That's exactly the point where we are now. I think what's good is Japanese equities, they've undershot now. I think some of actually, in terms of the sectors as well, when we look at industrials, they've clearly undershot. So there are some sectors, some markets that have really undershot. Probably the front end of the yield curve in the US has been and is pricing a bit too many cuts now. So that is probably something you will want to start to fade, particularly around the probability of an intermittent rate cut. But overall, I think also on the commodity side, right, when we look at energy, for example, I think we've buried the inflation theme a little bit too quickly. It's not like I'm saying, the market shouldn't bury it. It's going to be a next inflation wave or something. But are we really going to see headline CPI going to like almost 1.5% in a couple of months? That seems a bit too premature.
Well, I guess we'll find out. Max Kettner, we'll leave the conversation there. Chief Multi-Asset Strategist over at HSBC. We thank you so much. Coming up on the program, we're going to go from the macro to the micro and look at your stocks to watch, including Bayer, as it posts a revenue beat and raises its sales forecast for its pharmaceutical division. More on that story next. This is Bloomberg.
The market got carried away by demanding intermittent cuts. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation such as the ones we've seen before.
I wouldn't have expected the market to react with such a haste and panic the way it did. And so I think that the Japan story, the carry trade, is actually what's causing a little bit of chaos in the markets. And I think that, there really has been an immediate reaction to that.
We're getting closer towards the end of this kind of manic kind of price action because it was very much driven by technical factors.
It's good to see that today we have a rebound in the markets, and hopefully this breaks the fever. But I think we're still in fairly uncertain terms at this point in time, given that in some of the regional markets, we're actually still doing quite well on a year-to-date basis, and the investors are sitting on profits might be taken to take some off.
Thoughts on the Monday that was. Bloomberg TV guests reacting to yesterday's market rout. We're seeing something different today. Let's talk about that with our Markets Live executive editor, Mark Cudmore, who joins us to talk about the markets in 3 minutes. Mark, good morning to you from London. So from where you are in Singapore, are you buying this turnaround Tuesday?
Well, it is certainly a turnaround Tuesday. It was the classic setup, selling on Thursday, Friday and Monday, and selling of more than 1% each day. And that is the classic turnaround Tuesday signal, which means we are very, very confident we get a bounce today. And that is what we're seeing. What does this mean? I have to say it's not particularly encouraging for the long term. Take the center of the storm, Japanese stocks. They rallied 9%. 9%. Biggest move, up move since 2008. When is a 9% move disappointing? When it doesn't even reclaim the losses of the day before. A 9% move is essentially a dead cat bounce in this situation. There is still massive damage. So normally what you get in a turnaround Tuesday is that the gains continue for another couple of sessions. And if we are in a slightly negative market, we'll start getting nervousness again by the Thursday. That is how the classic setup works. I'm not saying it's a strict guideline, but I expect that we'll continue to bounce a little bit more today, probably bounce a little bit tomorrow morning as well, in Asia at least, and then we might get a bit more nervous towards next weekend. I don't think that we've seen the lows of this sell-off yet in most assets. And I think some assets have not properly corrected at all. I'm looking at credit as the obvious example here.
Mark, does volatility go back to where it was, or does it stay more elevated?
Both. What I mean by that is, I think volatility subsides from here. I think it's going to be hard for us to reach the extremes of volatility that we had yesterday on any immediate basis.
Sure.
I'm not, even though I think we have more weakness to come over the coming weeks, I don't expect it to reach those extremes. But no, the lows of volatility are behind us, and I expect volatility to stay elevated in August, just not elevated at the levels we saw yesterday.
So this is all about positioning, Mark, and this is all about kind of reversing moves that you saw 24 hours ago. When do the fundamentals kick back in? Is there a data point that you're watching or a moment to say, okay, well, now this is more about the fundamentals than the positioning?
It is largely about positioning, but there are three fundamental drivers to some extent that are all tenuous or valid for different reasons. One is the sudden concern about a hard landing in the US. To me, those fears are overblown, and I think that one we probably correct a little bit more next week when we get retail sales, CPI. We've already started correct from ISM yesterday. Then there's the two other factors. There's the AI disappointment. That's one where we're just going to probably recalibrate, to use Guy's words, to a more sensible level of valuations. It's not that the story is invalid, it was that people were getting too euphoric about it, too exuberant about it. And the final part of the story is the DOJ policy misstep that has blown up the carry trade. And I don't think we've fully exercised those demons. And I think the next part of it is a much slower moving one that plays out over the next month or two, because it's the structural carry trade in those derivative notes, in the structured notes, in the real estate lending around the world. So that comes through slowly over the next month or so.
All right, Bloomberg Markets Live executive editor Mark Cudmore joining us this morning with his take on the markets. You get more up-to-date analysis from him and the team. Just type in MLIV GO on your Bloomberg terminal. Let's get now to our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Kriti. So buyers' sales beating expectations today due to better than expected results for some of their cancer and kidney medicines. The company raises its sales forecast for the pharmaceutical division, though in agriculture and fertiliser it does note a continued challenging market due to adverse weather. If we look over a one-year view, we can see the stock down almost a half. A lot of this, of course, related to continued legal worries around their Roundup weed killer, and that does seem to be the main issue at the moment. In terms of analysts, no one really that keen on betting on a rebound for this stock. Most analysts remaining on the sidelines, 18 holds, 7 buys, but this looks like a bit of a mixed report in terms of those two divisions. Then in terms of hotels, we've got IHG, the owner of Holiday Inn. Now, revenue per average room up around 3% for the half year, and dividend well above expectations as well, though profit is down due to a decline in China, which saw a really strong year last year as there was a bit of a post-COVID bounce in that market. This is actually one of the better performing hotel stocks, though, over the past year to date, given they've done a decent buyback recently, and potentially that revenue per average room might be the highlight of this earnings report today. Then in terms of Aberdeen, we looked at this one yesterday, given speculation around the new CEO. We haven't got confirmation of that, but we have seen net outflows continuing at the UK asset manager, almost £1 billion flowing out in terms of pounds over the past half year, and fee revenue down around 8% at the company too. The highlight in terms of the positive, the cost-saving target, actually around 150 million per year. They're reiterating that. That might take the sting out of some of the negatives. But this stock down pretty significantly over the past 5 years, given those outflows of funds. And that does look to continue today. That could be the negative point for Aberdeen in London this morning.
Joe, thank you very much. Our equities reporter Joe Easton with some of the stocks to keep an eye on this morning. Interesting. So we've been through all of the themes that were driving that sell-off yesterday, haven't we? In terms of the US slowdown, the carry trade unwind, concern around tech valuation, all of it. Interesting what Mark was saying there about even just yesterday in session, we got some better news on the US economy. It's just one other data point, but we're also supposed to be so data dependent these days. But the services ISM number coming in much higher than the previous month, and that is where most Americans work.
Yeah, well, the sensitivity to the downside is clearly more larger, I would say, than the sensitivity to the upside. So if you have a positive data print, it's kind of like, oh, well, it's the continued economic resilience story. But there's that payrolls report that we have to see. Is that one data point, or is that going to continue in the next set?
But it would be hard for the Fed to deliver an emergency cut, given where the ISM story kind of came through yesterday. Huge part of the economy, as Anna says.
Yeah, absolutely. So we will get Tuesday's session underway for you. Turnaround Tuesday certainly underway over in Asia. We got the Nikkei 225 up by 10%, but it dropped by a substantial amount yesterday. So we keep that in mind, of course. Futures here in Europe do point slightly higher. This is Bloomberg.
Tuesday the 6th, couple of minutes to go until the opening trade here in Europe. Is it going to be a turnaround Tuesday? If it is, it doesn't look that convincing this morning. So you're not seeing the stock bounce back that we've seen out in Asia overnight, particularly in Japan. But even that hasn't been that dramatic if you look at it on a longer-term chart. So this is where we are coming into the session. This is yesterday's session. Europe closing at the lows of the US session. So we saw a little bit of a pickup after that. That's probably feeding into the narrative that we're seeing in terms of futures this morning. But Kriti, futures are up. They don't feel convincingly up. They're up nicely, but not extremely.
I don't know. It feels like a decent move to the upside. Maybe not in Europe, but you're certainly seeing that in the States as well. S&P futures higher by 1%. They were higher almost 2% earlier in the session. So, Guy, the fact that we may be pairing some of those gains is going to be crucial. I'm going to point out some outperformers in the FTSE 100. Some of that might be the oil story as well. We're going to dive into what's underneath. But when you compare also, Anna, between what you're seeing in the CAC and the DAX, you're actually seeing underperformance in the French index futures and outperformance in the DAX. It'll be curious to see whether it holds up at the open.
Yeah, we'll see whether that really does come to pass. In terms of some of the individual stock moves, doesn't feel like a week where those individual stories cut through much, but we do have a few worth remembering. We were going through these with Joe Easton. Bayer certainly in focus. Inline profits, but sales coming in better than expected. New cancer and kidney drugs in focus there. IHG, we'll be speaking to management there shortly. The dividend coming in better than expected. I wonder what thoughts on the Paris Olympics. That's certainly something that we want to keep on our radar. Aberdeen in focus in the money management space. Yes, inflows in the first half of the year, but they're searching still for a new CEO, and so that clearly adds to a little uncertainty on the stock. Guy?
OK, here we are, 10 seconds to go until the opening trade here in Europe this morning. We are anticipating that we are going to see a bounce for European equities. How convincing will that bounce be? Have positions been cleared out? We're about to find out. We'll see how the session develops. But here we go. Time for the opening trade here in Europe this Tuesday morning. And what we are already seeing is some green on the screen, as anticipated. But how much green on the screen? I know it's hard to tell exactly at this point, simply by looking at one index, which is the FTSE 100, which is open 0.2% higher. Stock 600 up by around 0.5%. You've got the IBEX up by around 0.1%. Let's see how much momentum we get into this trade over the next few minutes and how much higher we can push. But I think it's always going to be on days like today that you want to look at the context. You want to look at the last 2 or 3 days just to give you an idea of really where we are. Don't look at the single session. Don't look at the dip buying in isolation. Look at it in context in terms of what is happening here. Kriti, let's talk about the details of what is going on under the hood.
Well, Guy, right off the bat, some of the moves you're seeing seem to be in some of the mega cap stocks. And actually, your sensational six, if you keep looking at them, Novo Nordisk, for example, and ASML are your two biggest index contributors to the upside. So that's going to be pretty significant, including some of your other tech players as well. SAP is one, of course, that we know that got hit pretty hard yesterday as well. As some of the oil names are starting to come through as well. Shell, Total, for example, Anna, you are starting to see some of those moves. BP even. It's kind of the underperformers of the last couple of days are the outperformers today.
Yeah, absolutely. Banks in that mix as well. So a bit of a rebound in technology, a bit of a rebound in the banking sector. And if we were thinking yesterday about the speed at which central banks might cut rates, maybe that's negative for banks. We saw that as one of the global themes. Today be something a little different. We do have some sectors still in negative territory this morning, just a few of them. Utilities, personal consumer goods, consumer products and services is one of the weaker spots. And we do have that weakness on the CAC 40, which is interesting. Some of the luxury names do seem to be suffering today. So the likes of Richemont, LVMH, Christian Dior, L'Oreal, we see weakness in some of those luxury stocks.
Take a look at the Stock 600 over the last three sessions. We're still down by 5.5%. So we are still down heavily at the moment. In terms of the longer-term picture. I'm not even sure 3 days classifies as a longer-term picture. So we are getting a little bit bounce this morning. But if you take a look at it on the 3-day chart, it looks like a very, very small bounce.
And our colleagues in Bloomberg News putting this in context, talking about the last 3 weeks and calling this a $6.4 trillion rout over the last 3 weeks. And to some extent, we need to keep that in our minds as well.
Let's get another take on what is happening here. Maria Manucci joins us, fund manager at M&G Investments, sitting around the table. Nice to see you this morning.
Good morning.
What do you make of what we've seen over the last few days? Put today in context. Tell us what your clients are asking you about what they do now.
Well, I think, as we were saying, it's about the last couple of days, but it's really something that has started earlier than that. And a lot of the factors that have been driving some of these risk-off momentum in markets have been at place for a while now. If you look at things like the slowdown in momentum in terms of the growth picture, but also inflation normalizing more and more, the starting of the cut cycle on rates across the globe, really. So there's been many of those elements that have been at play for a while. I think, to me, the biggest shift has been that while for the first part of the year, the market has been able to be upbeat thanks to the AI narrative that has been coming in pretty strongly. The last few weeks have seen a bit of a loss of momentum on this. We started to see some challenges around, this AI spend. What would it actually mean in terms of short-term profitability and revenues for those companies, and more at large for the economy? And with that starting to crack, I think some of the other issues came to the fore a lot more strongly, and those were then exacerbated by the first cut within the Bank of England and this differential of behavior across central banks.
Does it feel like that we are heading into a recessionary environment? That's what the kind of the other big challenge has been over the last few days, is the market's trying to get its arms around understanding whether we're no longer in a soft landing environment, whether we're moving into a hard landing environment.
Well, I think we certainly have the market been moving more with the odds on recession than it was before. But in terms of the data points, we still don't have enough evidence to be backing that scenario strongly. I think the labour market has seen the weakening that we've seen last Friday, but it's one data point. We know it gets revised. We know there has been, still
some weather factors.
Exactly, some weather factors around the hurricane, and also that we are in a stage of normalization of the labour market rather than sharp weakening. But having said that, we know the labour market can move very quickly, so it's definitely something to watch for the coming weeks and months. But I think as of today, we still don't have a clear picture of are we going to have a recession or not in the coming months. So the options are on the table, and I think this is why you're seeing the type of volatility you're seeing, but also today kind of like a more of a rebound or a pace in volatility in markets. It's going to be interesting this week because there isn't a lot of data out there to be able to point investors towards one direction or the other. There will be more next week, but it remains a question if this week we'll continue to see a bit more of price-driving price, or the high volatility bringing volatility with it, or if actually we're going to have a pause as we're starting potentially to see this morning.
Well, speaking of normalization in the labor market, let's talk about normalization in valuations as well. So many people are talking about these concerns of recession or whatever. How much of this is actually a big sigh of relief for the folks who want exposure to the stock market and didn't dive in because the valuations were too high?
Well, I think you definitely had a strong correction, but it's quite selective as well. So there are still areas of the market that were quite expensive 3 weeks ago, and they still are, to my opinion, pretty expensive. At the same time, you have pockets of the market that have started to rebound in, the first phase, if you want, of these last 3 weeks. So we had started to see a bit of rotation in the market, which I still believe are attractive, and today are potentially more attractive because of the widespread sell-off that we've seen in the past couple of days. So I think we have to be cautious, and overall, from an equity allocation standpoint, I would say neutrality is probably a good place to be. But within this neutrality, you have more opportunity for selectivity, especially after the recent sell-off that we've seen across markets, really in different regions, but also across different sectors as well. And in particular, those sectors that have been, lagging year to date, that have still seen some sell-off in the last couple of days, and it can start to be interesting, especially if we enter a phase of rate cuts in market in the coming weeks and months.
Yes, tell me about your thoughts on that, Maria. I mean, we were talking to Max Kettner earlier on. He was saying he thinks the front end of the curve is now pricing in too many cuts. And yes, there are a number of global banks now looking at 2 cuts in September and 2 cuts in November. When I say 2, I mean 50 basis points, of course, from the Fed. Is that too much, to get 4 25 basis point cuts in such a short space of time?
I think the treasury market has moved very, very quickly. We've seen moves that are pretty rare to see. And in particular, as we look at the short end of the curve, I think there is some cautions to be had there. Overall, across US dollar duration, still pretty positive. I think, if you look at the long end of the curve, 4% rough rate is actually quite interesting over the medium term. We're starting to see some decorrelation as well of the treasury market versus equities in this risk-off phase, and that's very positive for multi-asset investors. So still positive on duration, but less so on the short end, more on the longer end of the curve, I would say. We had, in the past few weeks, increased duration because we're starting to see this rotation in the equity market as a potential signal for more volatility to come, and that has paid off in the last week or so. But I think still constructive in the duration on the long end of the curve as an interesting diversifier for multi-asset in markets that continue to be challenging from a macro perspective.
Do we think that we're going to be in a period of higher volatility from here? You don't have to look far to see political potential flashpoints. Does that keep us in an elevated... I mean, this wasn't driven by politics.
No.
But then you can overlay that and geopolitics.
Yeah.
Do we think that things are not going to be as low vol as they were over the last years?
Well, definitely on the equity side, you're potentially, looking at some more boots of volatilities coming in. Obviously, as I say, volatility has remained relatively well behaved within equities, and we've already started to see this breaking out a little bit. So I think, especially as you go through a phase of, potential rate path coming down, it's not a smooth path either. So it's not smooth on the way up, but it's also not simple on the way down either. So I think there is possibility to see some volatility and for investors to pick opportunities along the way. What's interesting is that we've continued to see high volatility within the fixed income market, the treasury market, and sovereigns in particular. And that potentially might, subdue a little bit if we start to see this decorrelation starting to take place again between equities and bonds regaining this role of safe haven, which they kind of, have a difficulty to maintain in the last few years.
Yeah, kind of going back to a little bit of the normal roles that everyone kind of plays in a portfolio. Maria Minucci will lead the conversation there, fund manager over at M&G Investments. We thank you so much. Guy, when you look at this market action, it feels like it's a story of the mid-cap stocks.
Yeah, big caps are coming back. As you pointed out earlier, this is where we saw most of these stocks, most of the action yesterday. They were pretty badly beaten up. This is where you probably buy in first. It's the easiest place that you would necessarily want to buy in first. You can see it really across the board in terms of the stock story here in Europe. The big cap stocks, Novo, LVMH, ASML, all higher. The more safety trade story, Nestle was certainly an area you could see some safety yesterday. That's not budging very much. Interesting that luxury is not having that great a morning, which is interesting as well. So Ferrari a little soft as well. LVMH struggling in and out of positive and negative territory, Anna.
Yeah, the CAC 40 is up actually now, but only by 0.2%, so underperformed still a little bit, and luxury is part of that, but also Selloff weighing on that market. Let's get a check on some of the individual stocks then on the move. Joe Easton has a briefing. Joe.
So the best performing stock we've got today is Banca Monte dei Paschi out of Italy, gaining the most in 18 months following the company's earnings report. Now, their net income in terms of their interest income, their fee income and their expected dividend, all beating expectations. That was up as much as 10% at the open. Then in terms of over in Germany, we've got Zalando, better than expected sales for the clothing retailer, only up 1.5% at the moment. And Aberdeen actually bucking concerns around those outflows at the fund manager, potentially the cost-cutting helping over there. Travis Perkins, the UK DIY firm, meanwhile, actually reporting weakness in its French business over in the Toolstation unit today. So that is weighing on that stock today. But those are the big moves in terms of the corporate earners. Then we mentioned IHG. That was one of the best performers at the open of trade, coming down a little bit now, up 2.5%. Revenue per average rem pretty strong at the moment, and their buybacks also continuing as well. Bit of a rebound, some of those other hotel stocks, given the declines we've seen over the past few days. Melia in particular up 3%, but also Whitbread and Accor as well. Wanted to check in on some of the energy stocks, given that move of only around 0.7% in the Brent price. WTI a bit higher, BP coming up, Total not seeing too much of a move. And checking in on the defence stocks as well, given continued concern around relations between Iran and Israel today. A little bit of a move higher in some of those companies, Rheinmetall and BAE Systems. Another sector to keep an eye on, of course, is tech. Now, Deutsche Bank, in a note today, upgrading the sector to neutral from underperform. They note that 30% of the downturn in European stocks that we've seen recently has come from tech. And these were some of the worst performers yesterday. Bit of a rebound coming through in Just Eat, Capgemini and SAP, but actually ST Micro over in chips continuing to decline very slightly. Finally, one single stock morning call to bring you. It's over in the health sector, and that was one of the best performers at the open as well. Argenx, this is the antibody company listed over in Belgium. Barclays likes that one on their earnings rebound, and the stock's up 3% in early trading today.
All right, Joe Easton from our equities team, we thank you so much for bringing us some of the stocks to watch. And coming up, we're going to dive into more of the company stories. Shares of IHG Hotels and Resorts higher this morning after the group posted pre-tax profit ahead of estimates. We speak to CEO Elie Maalouf next on the program. Stick with us. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 16 minutes into the equity market session. As you can see, it is a broadly positive one that we are watching. European stocks are bouncing back, but I would take a look at a slightly longer term chart and take a look at the last 3-4 days, and you'll still see that we have yet to really kind of close back the gap. So yes, we're getting a bounce this morning. Does it fill the gap left by the sell-off over the last few days? Probably not. One stock that is shining this morning is IHG, the global hotel chain, out with numbers a little bit earlier on. The buyback story continues. The market likes that. The RevPAR story looks pretty good, so the numbers are coming through quite strongly. The company's CEO, I think just over a year into the job now, Elie Maalouf, CEO of IHG, joining us now down the line. Nice to see you. Look, the numbers look strong at the moment. You're opening a lot of hotels. You're bringing a lot of capacity into the market. Demand looks like it is still reasonably elevated. I'm starting to see some evidence in the airline sector that they are starting to see maybe some cracks appearing. Is there any evidence that we are starting to see demand softening, or are these numbers consistent with decent momentum in the group?
Well, thank you. Good to be with you today. I mean, first of all, like you said, it was a good set of results for the half, accelerating in the second quarter in our RevPAR due to our global distribution, a good recovery in the United States, operating profit up 12%, adjusted EPS up 12%. So across the board, good flow through to our results. And we're still growing. We added 129 hotels. We actually signed a record 384 hotels in the half. That's more than 2 a day. We continue our buyback, as you said. We're going to deliver return over $1 billion to shareholders this year. So we're pleased with the trajectory, with the performance of the business. You know, airlines are not a direct read across to our industry and to our business. Most of our travel is still motorway travel, and we've seen in the U.S. record Memorial Day, record 4th of July travel. Yep. AAA is projecting record summer travel. So is TSA projecting record passes through, security passes through the airport. So it seems like a very good start to the summer. And even beyond the second quarter, looking into July into August, we're seeing, broad continuation of that trend.
A lot of people in the markets, Ellie, over the last few days have got very concerned about the fact that we are heading towards a recession, particularly in the United States. What I've just heard from you doesn't sound like a recessionary environment to me.
Look, the data is early, and we don't draw conclusions from a few days of volatility. We watch it carefully, as you would too, but we don't draw any conclusions yet. We wait for a few more months to see if any patterns emerge. We're not seeing anything in our business for the moment. I'll also reflect on some of the data. I mean, yes, we saw unemployment tick up to 4.3%, but actually, if you go underneath it, you look at the number of people employed, that actually grew in July over June. And the unemployment rate was more driven by more people coming into the labor force. So more people working is actually still good for our business. And so I think that if unemployment settles down in the low fours, if long-term interest rates, come down as they have, if inflation stays lower as it's come down, that's actually a pretty supportive environment for economic growth into the rest of this year, into next year, and very supportive for the development of our business. So we're not seeing anything in our information and our performance right now. We keep watching the data, but I think there are different views that the economy can still continue its growth. Over the last 2 or 3 years of recovery since the pandemic, there have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
Well, Ellie, speaking of that demand story, and I appreciate that it is looking good and things are all kind of rosy from your perspective. I'm curious when that translates to things like pricing for your actual business itself. How much headroom do you have right now to actually increase that pricing? And this is in comparison to some of the story we've heard from other consumer brands like Chipotle, for example, or McDonald's. And I understand it's a different sector, of course, but the conversation you're hearing there is that there isn't actually much headroom to increase pricing. How much headroom do you have?
There are different sectors, as you said. If you look at pricing for our industry in the United States and in Europe, it's actually only kept up with inflation since the end of the pandemic. There's been inflation, which has subsided, but our pricing has not exceeded inflation, so we don't think we're ahead of it as maybe some other sectors are. And our business is still growing. It's not just really a pricing growth business. It's a demand growth business and a footprint growth business. We grew our system 3.2% year over year. We opened 126 hotels. We signed a record 384 hotels. When you look at the long term of this business, as long as GDP continues to grow, as long as the middle class continues to grow, travel is something people are really preferring to do and continue to want to do. And so we're very optimistic about continued demand growth going forward in the long term.
So, Ellie, that's the optimism and the resilient story in the States. Walk us through what you're seeing in China in particular. I'm looking at numbers here that your room revenue actually fell for that part of the world. Yeah. When we're talking about that middle-class consumer, what are you seeing in Asia?
Yeah, good question. Our comparable RevPAR did decline in the second quarter after being up in the first quarter. There are a few things at play in China. First, in the second quarter, we're coming up against very strong comps in 2023 second quarter when travel restrictions were lifted and we saw a surge of demand, mostly domestic. Second, that demand which was domestic last year, quite a bit of it shifted to international outbound from China, mostly into nearby Asian markets. So actually our Asia Pacific region was up 15% with nearly every country, Thailand, Vietnam, Japan, South Korea, Singapore, up double digits. So we benefit from that, although it was not so much in China anymore. The third is that international inbound to China, which has been recovering, still is a long way from when it was in 2019, and we still have some demand recovery there. So we're still optimistic, very optimistic about the long term in China. That middle class that you mentioned, that's expected to grow by 80 million households over the next 10 years. 80 million households. And then you have a penetration of hotel rooms per capita that's still 1/7 of what that is in the United States. So an industry is underpenetrated. Our hotel owners in China seem to agree. Our openings increased 50% in the half. Our signings increased, nearly 40%. We're going to reach nearly 800 open hotels this year in China with another 500 under development. Look, we know it makes highs and lows, but it makes higher highs and higher lows. And we're very optimistic about the long term in China.
OK, so that's the optimistic story around China. Ellie, could I bring us back to the UK? And I want to ask this question not because it perhaps shows up in the bottom line, but because it's got just had a lot of attention on it over the last few days. Far-right violence in the UK, pockets of the UK, I should point out, and at least one of your hotels being caught up in that. I'm sure your focus is on your staff and the residents of these hotels, but what can you tell us about how this impacts on the business? I'm thinking whether the costs are insured, for example.
Well, look, first of all, it's sad. It's troubling to see these scenes. We're confident that the authorities, the Home Office, the police will restore calm and order. And we're working very closely with them to assist in that. In the UK, we have 350 hotels out of our 6,400 plus around the world. So it's about 5% of our system. There is a very small number of these hotels that are with the Home Office right now. And so it's really a very small part of our business. We don't think it's going to affect our business, but really our first priority is the safety and security of our hotel staff and of the residents. And we're confident that the Home Office and the police will do their best to protect it.
Moving to another geography, but close by, Paris and the Olympics has got a lot of our attention then, Ellie. We've heard anecdotally from some in the hospitality sector that maybe this hasn't delivered against high expectations. I know that this isn't the biggest part of your business by any stretch, but what can you tell us in terms of high-frequency data coming out of Paris? How is the Olympics doing for hospitality?
Well, first of all, it's been a thrill to watch some of the events and the athletes. I wish I'd been able to go in person myself. But look, we have less than 70 hotels in France, a little more than a dozen in Paris, but we're very pleased with the performance. Very pleased with their performance during the Olympics and throughout the summer. So I don't know what it means for others, but our hotels in France and in Paris have done quite well.
You've done quite well. No sense that people didn't show up for this Olympics?
Well, I'm sure that when you have major sporting events, you have some people don't show up, mostly business, but then a lot of people that show up to see the events themselves and enjoy them. In our business at IHG's hotels in Paris and in France, it's been a good Olympics and a good summer so far.
OK, Ellie, thank you very much. IHG Hotels and Resorts CEO Ellie Malouf there, taking a trip around the world. A positive story coming through in China. And to your point, Guy, not a story in the US that sounds like recession.
Sounded really quite positive. He doesn't necessarily draw a line between the weakness we're seeing in the airline sector, and we've seen warnings coming through from airlines like United over the last few days. He doesn't see necessarily a very strong connection. A lot of people drive to his hotels, which tells you, again, something about maybe what we're seeing there as well. But it's interesting. It doesn't feel like he sees a recessionary environment.
But it's also a little bit of a trade-off, right? Is when you can't fly to, say, see the Olympics, for example, you drive instead. You take a road trip. It's the classic trade-off, especially right now when you are seeing actually gasoline prices fairly high. There's an incentive built into that. I'm curious how much of that is an income gap kind of story.
Yeah, is it the ultimate trade down then? Well, that's a very positive story coming through from Ellie. So perhaps we'll ask those questions next time around. Coming up, we will focus in on the UK. UK Chancellor Rachel Reeves declines to rule out increasing capital gains tax. More from our exclusive interview. She has been visiting New York, also about to visit Canada. We'll get the view from the road. This is Bloomberg.
Good morning. This is the opening trade, Tuesday the 6th. We're 30 minutes into the equity market session. This is what it looks like this morning. You are getting something of a bounce, but it's not exactly a convincing bounce, is it? We're up by, let's call it, circa 0.8% for most markets. The CAC is definitely underperforming. Luxury looks like the laggard this morning, certainly when it comes to the French market. And if you take a look at the picture since the beginning of August, 1st, the 2nd, the 5th, the 6th, which is today, we are still down by 5.2% on the stock 600. So equity markets are bouncing a little bit, but it's not convincing yet. Have we seen the clear out of positions as well, I think is another question we still need to ask. Volatility, Anna, has come down, but it still remains relatively elevated. Therefore, are the systematic funds going to continue to sell? Are we going to continue to see some of this unwind that we've seen over the last few days continuing into the rest of this week?
Yes, and it's interesting. We've talked to a number of people about this turnaround Tuesday and whether they're buying into it yet. And there's a little too soon, seems to be the soundings we've got this morning. Sometimes for similar reasons, actually. They do think there is a time to buy in, but maybe just not yet.
Well, I think that the positive sign here is that the volatility is coming down, even though it was very high yesterday, and even though the trajectory may still have a ways to go. It is coming down, so maybe by the end of the week things will have a little bit more clarity on that front.
But how long does it take to clean out these positions, I think, is a really interesting question. Often the models don't update particularly quickly. Volatility has been really low for a really long time, so the pressure within the system on the upside has built up really quite significantly. And it probably takes a few days to clear that out. Now, we've had a few days of selling. Is this something that is going to necessarily need to persist? How much of those weak hands have been cleared out, I think, is an open question at this point. And I think, to Anna's point, that is why I think you're still seeing the caution. I'm seeing note after note this morning saying we're not sure that all of the positioning is done yet. We're not completely convinced that all of this has been worked out. So maybe there is still more to come. So a choppy week.
Yeah, choppy. Interesting that Max Kettner was able, though, to give, even if it is too soon, able to give us areas that he thought have been overdone, oversold, risk assets that have overdone it. So, for example, Japanese stocks, that seems like a fairly obvious one.
Yeah.
They bounced back substantially today. Industrial stocks, and then the front end of the curve, he thinks now we are pricing in too much in terms of cuts there.
Well, I got to say, and this might be the journalist in me, but I'm ready to find out who got the margin calls, who had to panic really, really quickly, and who the bigger players are. Because in the previous crashes that we've seen that have been so quickly, I mean, a 45 basis point move in the 10-year in the span of a little over 48 hours is massive at a time when no one was really betting on a bullish bond market, and yet here we are.
The bond market has performed in some ways admirably over the last few days. I appreciate that the moves have been extreme.
Gold star from Guy Johnson.
Well, yeah, the bond market for a long time has not done what it was meant to do. You've seen risk assets and what should have been balanced in your portfolio, i.e. the bond market, moving in the same direction. Now, that blows up a whole load of strategies which previously you would have thought that has worked. But over the last few days, you have seen this ballast in diversified portfolios, proving that they actually work. Does that mean you go back, therefore, to a more balanced portfolio? A lot of people have been super long equities. Are they going to maybe take a more balanced position?
I was looking at the GMM screen, which is sometimes useful as getting a sense of where markets are moving. And if you set it for month to date, it tells quite a nice story as to what's happened since the DOJ move, and if that was one of a number of triggers that has taken us into this place. But the sovereign bond column is just... It's the only green, really, on the screen. There's a few other currency moves. There you go. There's a couple. Yeah. We've got a couple of green screens. But the sovereign bond column definitely stands out as one of those areas, to your point about the ballast.
Well, you know, the disconnect between the bond market and the FX market is still fairly interesting. If you're seeing this massive move into the U.S. treasuries, for example, from the 2-year to the 10-year, where's the bid for the dollar? And I don't see that yet, really, except for against dollar yen. You're still seeing, even in yesterday's kind of turmoil, you saw a bid into Eurodollar, a bid into cable.
Yeah.
The dollar doesn't seem to be that haven, that safe asset that perhaps the treasury market or even the Japanese yen or the Swiss franc has been.
Are you getting the flows, therefore? Why is that? What is going on, and why are you seeing that? Why are you seeing that happening? Because in theory and in previous instances, you have seen, even when the U.S. economy is crumbling, the dollar act as an area in which you could hide out. That's not happening this time around. That's a really interesting kind of tell on maybe the perception. Maybe that's also the kind of perception that maybe the U.S. market's got the most overheated in its totality.
But this is also bringing it right back to the positioning story, right? The market was long dollar, so so many people have been sitting on dollars that they don't need to kind of grab them to access the treasury market or access the S&P 500 or whatever. So I feel like maybe that's the one spot in this market where we can actually say things are priced in.
One area we haven't talked a lot about is credit.
Mm-hmm. Yes. Mark flagged that, didn't he?
He was playing a little bit earlier on.
Hadn't adjusted maybe as much as he would have expected, although the chart still looks pretty dramatic.
Yeah, precisely. The chart does look dramatic. So you are seeing a funding story that is beginning to get a little bit more squeezed. And I wonder kind of that maybe is the area the Fed, other central banks do pay attention to. The cost of credit does start to materially be affected by what we're seeing here. That's a read back into the economy, and maybe you don't see this huge amounts of issuance. But a lot of people had already said that the huge issuance that we've seen was likely to be front loaded, that the back end of the year was likely to be more difficult.
Yeah, they were a lot of companies trying to get in ahead of very well telegraphed points in the political calendar where things might get a little unpredictable, and so that was the appeal, I suppose.
Well, in the context of the broader kind of risk appetite that we were talking about, especially with the carry trade, kind of this high risk, high reward story that's unwinding. In the absence of that, if you are seeking something a little bit safer, you can see it on your screen right now. This is the investment grade kind of corporate spreads here. It is, I can't see that far. It's about 111 basis points. This is what Guy and Anna are rubbing off on me. But if you look at the high yield market, for example, 381 basis points on that very similar spread. So I'm curious if now, in the absence or in that worry of the kind of carry trade unwind, do you start to see a bid into some of that riskier credit?
Maybe the sell-off of the last few days has undermined some of the gains that people have been making in their portfolio, which is my way of segueing into our next segment.
Excellent.
So beautifully done. Gold star for Guy Johnson.
Not really. 2 gold stars. Wow. One for the bond market, one for me. The UK Chancellor, Rachel Reeves, says that she will not rule out increasing capital gains tax after warning over £22 billion of a gap that exists in the UK budget now. In an exclusive interview, she told Bloomberg that she'll strike, quote, the right balance on tax at a budget that we are likely to see in October.
I think people should pay their fair share of tax, and one of the challenges we have in the UK is a gap between what should be collected by His Majesty's Revenue and Customs and what is actually collected. But we made a commitment in our manifesto that we'll be sticking to, which is that we don't want to increase taxes on working people, and we will be keeping income tax, national insurance and value-added tax at the rates they are for the duration of this Parliament. I would like taxes on working people to be lower, but I believe that you can't make promises without being able to say where the money is going to come from. But the tax burden in the UK has got too high. The tax burden in the UK is at a 70-year high. I want to bring that tax burden down because I want to make Britain the best place to start and grow a business, and I want working people to keep more of their own money in their pockets, and that's what people will have with this new Labour government. And it's why it's so important that we grow the economy, because the last few years in the UK, there's been lots of debate about what level of taxation and what level of spending, but it's missed the bigger picture.
Yeah.
And the bigger picture is growing the economy.
Well, as you mentioned income taxes there, Chancellor, I wonder, given the revenue it potentially could generate, if you're tempted to bring capital gains taxes in line with the income tax, is that something you're considering?
We've got a budget on the 30th of October and we'll set out our policy then. But it's always important when you're deciding tax policy to strike the right balance. Of course, you need to bring in the revenue to fund vital public services, but we've also got to grow the economy. And I won't do anything that makes it harder to achieve that economic growth and prosperity, because in the end, the only way we're going to lift living standards for working people and have the money that we need to invest in our public services, whether that is our health service or our schools or indeed our police and our armed forces, is by growing the economy. And so I am determined to ensure that when we set all of our policy, including tax policy, that we're not doing anything that will deter the investment and growth that we need to see in the UK economy. But we'll make decisions around tax and around spending at the budget and the spending review later this year.
UK Chancellor Rachel Reeves speaking exclusively to Bloomberg on her visit to New York, of course, talking to our team in Washington there, pitching the UK. Interesting then on the tax side of things, just to get very domestic, you know, she's talking there about private equity and carried interest and consulting on that. Interesting to see if they do try to dissect that into two halves, you know, the area of PE that's risking its own money and therefore rewarded for that, and the area of PE that is not doing that and therefore shouldn't be, in their view, rewarded for that.
If you put skin in the game, if you put skin in the game, you will get a better treatment in terms of the taxation, because you are taking risk, and that it is designed. The way that capital gains tax has been designed in the past is designed to foster risk. The problem is, though, that in some ways it has maybe become too broad, and as a result of which has been taken advantage of. So it looks like it feels like CGT is going up in some shape or form. But it looks like the government's probably going to borrow more money as well. It looks like it's going to change the rules. Rachel Reeves is going to change the rules to allow herself that headroom to do so.
Well, she's not denying.
Okay.
When asked, denying that she
pretty much
no
yes.
comment. Pleading with it. Well, I think the duality of that you highlight is really important, because if you ask the folks in the PE industry right now how worried they are about that carried interest story, they're not actually that concerned at the moment. And one of the arguments is that yes, it's kind of in the back of their minds and it is lingering over all these issues. But they're saying, look, this is still an industry that is thriving. The UK government is still trying to attract so much of that investment, to your point here, and a lot of that is being done through private capital as well. So there's also a part of the market investor base that they can't actually alienate from that front. But we'll actually see how that goes. This is all part of the bring tech and innovation and deals flow back to the London narrative.
Yes, and she goes to New York trying to pitch, invest in Britain, open for business, and of course then the photos and the images that are travelling around the world of Britain right now don't exactly play to that. But on your point about private equity, she's said she had a frank exchange of views with people from the PE and the VCs community.
Is that a good thing? Is frank a compliment?
Not usually, but I mean, maybe she appreciated that. She said they were pleased with some of the other stuff they were doing around the UK economy.
Clearly there are big spending priorities, and the last few days have highlighted that. I appreciate the riots we've seen in the UK. have many different origins, but one of those is that maybe the levelling up programme has not delivered over the last few years what was anticipated in some of these areas, and more effort is therefore going to have to be made and more money is going to have to be spent.
Yeah.
And that brings us back to the fact that she has some big priorities, she has some big needs for capital at the moment. How that comes in, I think it's going to be really interesting to see what this budget looks like.
Well, this is where you have to ask, is this kind of that Labour honeymoon phase that is starting to end a little bit? That if they are the political stability or island of political stability in broader Europe that you're seeing, can she capitalize on that, to your point? And it's something, by the way, that we're seeing in the markets as well. Not this morning necessarily, but we've seen that in the continued strength in cable. Cable at 127 right now, but still pretty elevated relative to, I think, some of the concerns around the deficit, et cetera, that you see in the UK. I want to bring another voice in here. Noor Ali, from our Bloomberg Markets Live team, joins us around the table. Good morning. Walk us through the take on the folks you're speaking to when it comes to investing in the UK. If we're talking about a catch-up trade in Europe, is the UK finally kind of getting its moment in the limelight?
Yeah, absolutely, Kriti, and that's the assessment, right? The British pound is doing very well. The Bank of England just cut interest rates. You know, if you're looking at the UK and the FTSE 100 as well, and the FTSE 250, which is the domestically exposed stocks, are quite undervalued relative to their peers. So if there's ever a time to invest in the UK market or to be optimistic about it, now is looking to be the time. You know, the summer is out. I've got way too many positives here to list, but I think ultimately the pound really rising is also starting to benefit those companies as well. You know, I've had earlier reporting on that as well from our colleagues in FX and rates. So it's really overall an optimistic story.
Okay, and that's the one she's taking to New York. We'll see what the budget delivers. In the broader markets then, Noor, clearly the risk-off story of yesterday being replaced by, I don't know, risk-on doesn't feel right, but a turnaround Tuesday perhaps at least. What do you make of the seismic moves we actually saw in bond markets yesterday with the inversion of the yield curve? That's right, isn't it? I've got the right words in the right order there. And what that tells us from here, because that happened really quite quickly, but then you get a sense it could unhappen quite quickly if we rethink how many Fed rate cuts we're going to get.
Yeah, absolutely. Look, that sudden shift in markets has been quite interesting, right? Suddenly, the markets have just turned. They dumped stocks at a time where they've been rallying despite a lot of the fundamentals or a lot of the macro signals that have said, well, maybe the valuations are quite lofty. Why are they still there? And the AI rally or that boom in AI has really carried that narrative through. And now we're starting to think, has that bubble popped? And in that light of everything, bonds, they're back because they came back as that sort of, okay, hi, we're here. We're the havens, we're the hedging havens that you're typically relying on. And so investors fell back to that familiar territory again. And you do see that there is room for those bonds for that bond rally to extend, particularly as the market is quite aggressively betting on the Fed cutting rates as much as two half-point cuts by the end of this year, right? But whether or not they do that may not be the narrative that's going to carry through as much as that sentiment that's driving the bond rally that we've all been waiting for.
We've been in a low volatility environment for quite a while. Take a look at the VIX. You can see the charts. And that allows risk to build up. You can build up bigger risk positions in a low volatility environment. Volatility has now come up quite sharply. How far down does it go? Do we go back down to where we've been really since the start of this year, sub 20, kind of in the mid-teens? Do we go back to that kind of environment, or does it remain more elevated than that period? And if so, what does that tell us about the ability of this market to take risk?
Well, Guy, the volatility beast is up. And once you wake that beast up, it's really hard to kind of move that away. And we've been talking now for quite some time, very perplexed as to why that VIX just was not rising, right?
Yep.
And now you even see the volatility of the volatility index, which is the VVI, the VIX, essentially also rising. So that's implying that we're going to see a lot more volatility into this summer. Also, a reminder, seasonality stocks don't typically do very well in August. It's pretty much a summer lull period. I argued over the weekend in our calendar post that actually I don't think that summer lull is going to come at all, right? And we're going to see a lot more volatility into Jackson Hole, right? August is going to be incredibly interesting for stocks and bonds, and I don't think it ends here.
Volatility doesn't come down to where it was before. Pay attention to that. It's worth paying attention to because it's going to have a big impact in terms of risk-taking. No, nice to see you. Thanks very much indeed. Emlai's Nur Ali joining us on what is happening in these markets this morning. Equity markets are a little bit bid this morning. They're not massively bid. What are we going to talk about next? NASDAQ futures are, though, a little higher. Big sell-off yesterday in the United States. Tech taking a beating. There's fundamental reasons around that as well. We need to talk about what is happening with NVIDIA. We need to talk about what is happening with Apple, etc. We'll do all of that next. That conversation is coming up. This is Bloomberg. We're 49 minutes since the opening trade here in Europe. As you can broadly see, we are higher, but not convincingly. Look at that. Some markets are even in the red this morning, which is interesting to see that happen. Luxury in particular is under a little bit of pressure. Tech a little less so. So tech had a bad day yesterday. Today we're seeing a little bit of a bounce back coming through, as you can see. Again, but these aren't big numbers. These aren't dramatic numbers today in terms of the bounce back. Now, remember, the NASDAQ was down pretty hard yesterday. It was down by around 3.5%. In 9 minutes' time, we'll get some pre-trade. We'll give you an idea of some of the big names and how they're trading into the US session, and we'll bring that to you in a few minutes' time. Let's get an idea of what happened yesterday. Tom McKenzie joins us around the table to give us his take. So yesterday we get a kind of a big sell-off, a broad sell-off. Tech goes down pretty hard. It's one of the most extreme positions. Understandably, if the market's going to sell off, therefore that gets pulled in. But there's also some fundamental reasons yesterday as to why we saw some of the sort of the darlings of the market recently coming under pressure. NVIDIA feels like the ones that stands out. But there's some M&A stories. There's some engineering stories that compounded maybe what we saw yesterday.
Well, there was the Berkshire Hathaway cut to Apple as well, so that stake of around 50%. But you're absolutely right to zero in on NVIDIA, because I think that's really important. The timing, of course, suboptimal in terms of NVIDIA and the reporting around this that came from the information. And we have done our own reporting around it, which is that this crucial set of ramped up chips, so this new iteration of their GP chips, their GPUs, their AI accelerators called Blackwell, which is the next round to come up after Hopper, which is currently the one that they're shipping to most of their customers, that there are delays around this next product. And that comes down to engineering complexities around two of these AI accelerators. Now, they've come out, NVIDIA have said, look, we're still on track to ship these in the second half. The fundamentals are still there. They still are not producing enough GPUs, enough AI accelerators in the Hopper version to meet the demand that's out there. So analysts are saying, look, fundamentally, long-term, the growth story, the revenue story is still there for NVIDIA, but, and this is a big but, doing the heavy lifting, it comes down to how quickly they fix these engineering challenges. And it's a reminder that as you innovate in this incredibly complex space, each iteration becomes that much more complex. Timing, NVIDIA want to be getting to a place where they're churning out new iterations on an annual basis. It's a reminder that there is a very, very ambitious goal. Interestingly, AMD saw some upside, even in everything that happened yesterday across these markets, even with that loss across the major index. AMD actually came through with gains because they are seen as benefiting from NVIDIA's challenges there.
So we wait for August 28th, don't we, until we get NVIDIA sort of on the record with the earnings and everything. Because the thing is that when you get this kind of story, these things have been, until recently, priced for perfection, haven't they? And so that's bound to raise questions. Let's go to other tech themes, though. And Kriti's been rightly keeping the Alphabet story on our radar and the regulatory questions there. I mean, a lot of the regulatory stories have been focused on Europe, but this one isn't. This one coming from the United States.
And the criticism often is that the US hasn't been able to sharpen its teeth around antitrust and around monopolistic behaviour. This time, though, it's the first time in 2 decades that regulators and the authorities and enforcement in the US have come through with this win. So it's monumental in that respect, it's hugely significant. To be clear, Alphabet, the parent company Google, say they are going to appeal. But what this focuses in on, and I was reading the transcript or the final verdict that came through from the court, and they said very clearly, Alphabet, Google, behaving like a monopoly, behaving with monopolistic characteristics. This is a monopoly. There was no ifs or buts about it, according to this ruling. And it comes down to the search engine and the fact that they've been paying, they make payments of about $29 billion a year to companies like Apple, to companies like Samsung, the hardware makers of those phones, to ensure that Google is the default search engine. That, of course, helps them in terms of advertising revenue. They generate about $300 billion annually from that part of the business. What happens next is they're going to go to appeal, but ultimately they could break up this unit from Android, from Chrome, which would be hugely significant. There's still an if there, or they could get them to unwind some of these incentives, essentially Google paying these incentives to Apple, Samsung and others to make sure that they're the default search engine. So that could come to an end. So there's still a lot of unknowns around this, but top line, as you know, Kriti, this is a significant finding from this and ruling from this court.
Well, this is my obsession of the morning, obviously, which I think ranted to you in a commercial break a couple hours ago. But this is not just a Google story. This is an Apple story as well, because you're starting to see the likes of Siri and chatbots kind of be programmed to use the same mechanism that Google has just been penalized for. And yet, on the other hand, you have the Berkshire kind of cut that you were just talking about. You have a couple of analyst upgrades, actually, out of Apple. Just basically, we don't believe in Warren Buffett. What is going on at Apple?
So Apple, well, there's the concern maybe around its exposure to China. And don't forget, they came through, actually, in terms of the earnings story, and that was part of the top-line picture that Guy was outlining for us in terms of the weakness across technology. And the most of the softness coming through from Alphabet, Amazon and Microsoft in terms of the concerns that came through from their earnings. Apple, to some extent, was a bit of an outlier because they said, actually, the growth has come back, we'll come back with revenue, and we're going to see this upgrade, this iPhone upgrade, on the back of our AI pitch and the software and the changes and adjustments that we're going to be putting in place and embedding in our hardware from October of this year. So actually it was a slightly brighter picture, arguably, even as you saw that 6.5% drop in terms of revenues out of China. But we got a reminder, of course, yesterday that there still are concerns around Apple with Berkshire Hathaway cutting that stake. And a reminder as well that regulators are looking at Apple, they're looking at Google and Alphabet here in Europe, here in the US as well, around this alleged monopolistic behaviour, and those regulatory challenges are not going away in either jurisdiction. And we've seen that Meta, for example, the parent company of Facebook, they face challenges around their payment after adjustments and after rulings from Brussels, and that hit them in terms of the top line.
OK, lots of threads then to the tech story, all of those individual corporate themes and the overall positioning around tech clearly making its presence felt in markets of late. Tom, thank you very much. Tom McKenzie, of course, with the latest on the tech sector. In terms of, team, the things that are on the radar, I mean, tech earnings is one of them. We're going to get some numbers, not from the likes of Nvidia, but Airbnb, Uber, and a reading from Caterpillar, which sometimes tells us something interesting about the global economy. And you wonder how that might land in a market that clearly is still nervous about US growth and the China growth story.
I'm going to do the one thing that I keep being told not to do, which is mention the Dow. And this is where the Caterpillar story is going to take a big hit because, of course, when you see that headline, the Dow plummets, however many points it plummeted, 1,000 points or whatever, Caterpillar is going to be a big part of that story. So even if you do see a recovery trade in Airbnb and Uber, or even just paring back some of the losses, Caterpillar could weigh out of the normal in the Dow.
Uber and Airbnb, I think, are both really interesting. They're going to tell us a lot about the consumer. Yeah. And I think that is what people are trying to figure out right now. The services data was strong yesterday.
Yeah, absolutely. Yeah, that's ISM, ISM services, which is where most Americans work, of course. Back to the jobs story. That is it for the opening trade. European equity markets bouncing back a little this morning. The Pulse is next.